Hey investors, today I'm going to talk to you about XEQT, which is a great ETF. It's the iShares Core Equity ETF. So let's get down and let's check out this amazing ETF. So the first thing that I always like to look at is the yield. It's currently yielding 1.65% at the time of making this video. From there, we want to also look at the volume, and the volume seems to be pretty healthy at 80,000 shares being traded on average every single day. This allows us to get in and out without too many hassles or issues. We can also see that the 52-week range is near its top right now, being 2464. If we think that it's going to reach back to its 52-week high, then you would only be getting around a 50-cent per share increase, which is only maybe 2%. So is this really a great ETF to buy right now? Well, let's dig a little bit deeper. So on its chart since its inception, it started at roughly $20 per share. It then jumped up to just past $22 a share in only a couple of months, which is great. You always want to see that. However, the coronavirus hit, and of course, it tanked. It died. It did not do very well. However, it did bounce back quite well, and we've seen this with many other stocks as well. And then it did consolidate, which is something that you always want to see after a massive jump. The lowest it did get was just under $17 per share. It has now gone for another acceleration in equity gain, and now it's starting to consolidate once again. And depending on who you ask, this could consider a flag, as in, it could start jumping higher once again very soon. Now, when we look at the dividends, we can see that it does not pay a dividend every single month. It looks to be only giving a dividend every quarter. Its top 4 holdings, which is 99% of its total assets, are other iShares ETFs. So let's dig a little bit deeper into what these ETFs hold. So ITOT, which is that top holding, holds these companies: Apple, Microsoft, Amazon, Facebook, Alphabet, as well as Tesla, Berkshire Hathaway, JP Morgan, and Johnson & Johnson. All of which are stocks that I personally like and agree with having forward momentum increases, especially Tesla after its big pullback. I think that it's got a lot more to run. XIC, however, is a TSX style ETF, and it holds Shopify #1, which that may actually change very soon, because when we're looking at these ETFs like XIC, it's a composite index, which means that generally it mirrors what the market is doing. I would actually assume that Royal Bank would take over its #1 spot, because it is now considered, unless something's changed today or after making this video, the Royal Bank of Canada have actually become the biggest company listed on the TSX. Next is TD, as well as National Railway, Bank of Nova Scotia, Enbridge, Brookfield Asset Management, Bank of Montreal, CPR, or Canadian Pacific Railway, and then also down here what you probably can't see is CIBC. The Canadian banks have a nice strong dividend, and they've been paying it. At least the big 6 banks have been paying a dividend without cutting or stopping a dividend for over 100+ years, so they are nice, steady companies to hold for the long term, in my own personal opinion. Next is XEF. This is more of a European style ETF, and it holds Nestle, as well as another iShares ETF, and then some other notable names that I really like as investment tools is SoftBank, Toyota, I almost said Tesla, and Roche Holdings, and of course Nestle. The rest are good too, but I personally like those. And the final ETF that this main ETF holds is IEMG, and it's emerging markets. Taiwan Semiconductors, I actually just recently made a video about that. And then Alibaba is another one, and Samsung. Now, if you are thinking that technology is going to be the future, which I personally do, this is actually a good ETF to invest in on its own. However, you can get all of these ETFs together by investing in XEQT. So as we can see, this XEQT ETF basically holds companies in throughout the whole entire world. Is this a good strategy? I personally think it is, because at least then, if one small market is starting to have a downturn, the other markets will prop it up. The only time you would see this really having any long-term downside effects is if we go into a worldwide recession, which we did see with the coronavirus pandemic. We may see it again in small certain segments of the market, including the United States and Canada, because of how much stimulus spending that these governments are really doing, how much money printing they're doing. So is there a possible downturn coming up? Possibly, but if you can invest in solid companies over the long term that pay a dividend, you don't have to necessarily worry about what your underlying asset is worth, as long as it keeps on paying you that dividend that you're expecting. And for at least part of this portfolio, the Canadian banks seem to do that really well over 100 years, which is multiple major recessions. I hope that this video has helped you become a better investor, possibly, or at least learn a little bit more about this ETF. If it has, hit that like button and subscribe, and I will see you guys again in my next video.